Well, good afternoon everybody and welcome to today's webinar on the demand for social investment and loan finance. I'm absolutely delighted we've got Fergus Lyon with us from the Centre for Enterprise and Economic Development Research from Middlesex University, who's going to take us through today's webinar. So we're going to start right now. As ever, we're recording the webinar and we'll also be able to send the slides out to you afterwards via email. So without any further ado, I'm going to click through the screen, and in just a couple of minutes you should be able to hear Fergus's voice and see his presentation. Thank you.
Hello everybody. Thank you very much for the introduction. I'm Fergus Lyon from Middlesex University, also part of the Third Sector Research Centre, and this work that I'm going to be talking about, much of that was funded through the Third Sector Research Centre programme, so many thanks to ESRC and the Barrow Cadbury Trust and the Cabinet Office who had funded a lot of that work. So what I want to talk about today is let me just get my screen sorted, hang on a moment. I can't think how to, sorry. Trying to shrink, I can't see the screen. That's one funny. There you go. Yeah, I'll be talking about this idea of social investment, the funding of social enterprises, and I'm going to have a particular interest and focus on loan finance. There's a lot of interest in this area, particularly from philanthropic funds, from the big lottery fund, also from public policy as well. The Cabinet Office has a big push to encourage social investment at the moment. And then we have organisations such as Big Society Capital in the UK. This is a fund of £600 million, which is a wholesale bank wanting to fund onto other social investment intermediaries who will then lend on to social enterprises. So it's a big sort of increase in the supply of funding for social investment. Also, we see it across the world. In the US, there's a lot of interest. Across Europe, there's interest as well. The Social Business Initiative as a big European-wide program trying to encourage social ventures and of different kinds, but seeing that finance is a key area of that. So there's a lot of different innovations and different approaches that are being encouraged. Forms of lending to social enterprises and other social ventures. There's all sorts of different ideas being promoted from what I call the supply of social investment. And what I particularly want to look at in today is the actual demand. Who is actually demanding it? What do social enterprises at the moment, what are they actually using? And also to see where are those gaps. Where is it that there is a gap, that there might be a supply and there might be demand, but where are the two not meeting, and what can be done there? So really, the other thing we'll be looking at so when we're looking at that, we can look at both who are the users and who are the non-users of this as well. So when we look at the sort of users and the non-users, I'll go through it towards the end and set out a sort of what you could call a segmentation, a different way of breaking down all the types of social enterprises into those who are using, those who are not using, and sort of the different sort of support required for each one of those groups as well. So quickly, I've been referring to the concept of social enterprise, and quickly to go over what I mean by that and the sort of the scale of the sector as well. And so I'm looking at social enterprises as organisations that are defined as organisations that are both trading and they have a social purpose, as a core social purpose. So I know we could also refer to social ventures and other forms of organisations, again, which meet the same requirement. And the key issue here is that they are organisations that have a degree of trading activity. And that's quite important when we're looking at the financing. I've not really we've got quite a loose definition that could be used to look at social enterprises. You could have a very wide and loose definition, and some surveys showing up to 180,000 social enterprises in the UK. A large proportion of these would be private sector businesses and self-employed people. Other people take a tighter definition where there might be organisations with a clear focus on meeting specific criteria, also sort of defining themselves as social enterprises, but also having this idea of an asset lock, having a legal form that means that those people who are running the organisation can't take the surplus for themselves and can't sell the assets for their own personal gain. So if you take this tighter definition, you might, I estimate that there might be between 20 and 30,000 social enterprises within that. And they could be all sorts of different legal forms. A large proportion of charities are combined while also being companies limited by guarantee. You also have a growing number of community interest companies. There's a range of different industrial and provident societies or cooperatives of different kinds. And then you also have companies limited by share and partnership, the more sort of private sector legal form, which can still be social enterprise, as many of them of these organisations, those types of businesses, there's a large number that do have a core social purpose. So with that, having a primary social purpose, I see that as making them a social enterprise. But it's important to look at all of these different types. But for this bit of work I'm going to be presenting the data on are those organisations which have a more of the narrow definition of social enterprise, those with more of an asset lock, and those with a very much a core social purpose, and those which self-define as a social enterprise and are linked into some of the social enterprise related networks that we have in the UK. So, while I said at the beginning, I mentioned that we're very interested in looking at this idea of debt finance and repayable finance for social enterprise. There's been a long history of different types of support for social enterprises, and a lot of it coming from forms of grant finance, to allowing these organisations to grow. But also there has been, over many years, many social enterprises and other forms of social ventures have been using forms of repayable finance, particularly seeking investment from banks, and also other forms. It might be loan finance. There's also some interesting areas I'll talk about of looking at equity finance of organisations giving out an equity stake. And this is a particular area of a very small area in social enterprise, but some very innovative things happening in this area as well. So we can look at the types of the providers of the finance, and there's a lot of discussion on the role of the social investors. So these might be some of the social banks. There's a range of sort of intermediaries, such as social investment business, or some of the banks like Triodos and others, and they're playing key roles in providing sort of specific loan finance, but that combines both a financial, it's repayable financially, but also it has a core social purpose as well. So it's combining the two there. But also, what I'm going to look at later as well is what is the key role of banks and other sources. And I'll show later the important role that banks have played and will be expected to play in the future. So how can that existing forms of finance be channeled to have a greater social benefit as well? So that's a real key challenge. So looking at this, as I said, these are issues that we find across the world, but looking particularly in the UK, we see this growth of social investment as I call it as here a dominant discourse, a sort of the language that has sort of replaced over the last sort of 4 or 5 years a lot of area of the support for social enterprise. In the past, there's a lot of capacity building support and other forms of grant support, and a lot of the discussion now has moved into this area of social investment and loan finance, and looking at use it, particularly where there's policy and public sector support of trying to promote investment readiness, a concept I'll discuss in a moment. And also sort of looking at this growing number of providers. And this is where you can see sort of an emerging industry in the provision of social investment, a whole range of different types of providers, and with big society capital encouraging all sorts of different innovations and different sort of funds looking at different sort of segments of it. I'm not going to go through those in detail. There's sort of other materials elsewhere I can guide people to, but there's a whole range of other innovations as well. But here, what I'm concerned about slightly is this assumed demand. There is a sort of expectation that this is what that loan finance can replace other forms of business support and social enterprise support and grant support. But also there's questions about, are there enough social enterprises willing and able to take on these forms of debt? So we've got questions over the who is demanding this investment. So there are organisations looking for investment to allow them to grow, to scale up their impact, and with a small amount of these organisations able to have a big impact, but also often finding difficulties in accessing some forms of finance. But also what we're finding is a resistance to debt as well by a large proportion of organisations. So particularly those which are more maybe don't have such a long history of sort of enterprise activity, and also those not willing to take on the risk of debt finance. There is that resistance. And I think we have to recognise that this idea of social investment is a very important topic, but for a small part of the social enterprise community and the social venture community. So really, if we are looking at those, what is that segment, we need to know which of the organisations that are willing to take on the debt finance. And particularly there, any organisation that's looking at taking on debt finance, the key question that always has to be focused on is the ability to generate a surplus. I think we have a lot of talk here around investment readiness. And really, one of the key things of being investment ready is to have, and to take on loan finance, is do you have a really good business that can generate a surplus that can then repay back the loan. And that is one of the crucial things. And so maybe, while there's a lot of talk about investment readiness, what is really a crucial thing here is just being market ready or business ready, of having an enterprise that is viable, that can generate a surplus, that can then not put the organization at risk. So that's one sort of key area of investment readiness, is just having a decent business. And there's a real risk of pushing repayable finance and debt finance onto organizations that might be that might not be quite ready, that might not have that ability to pay it back. And a second area of investment readiness is the sort of the experience in applying for finance. So you might have organizations that have a great business that can generate a surplus, but they don't have the experience in presenting their case to those funders in a way that the funders require so that they can judge the quality of the organization. When we look at this in terms of social investment, it's not just the sort of financial elements of the business case that they're looking for loan funding, but it's also looking at the social mission and how to demonstrate that. So at the end of the talk, I'll go on to how, if you're trying to demonstrate both your financial and your social benefit, how do you do that? What are the sort of key challenges for looking at social investment that way? So we have that area. Then we have a other area, which those people who might be looking at growing, are keen to grow, but they're sort of discouraged from borrowing as well. And I think this is an area where we want to separate out as well. And this is something that's been discussed in relation to small businesses around the world, is this idea of discouraged borrowers, those who have the potential to grow and have the potential to take repayable finance to allow them to scale up, but they've been discouraged for one reason or another. And we want to look at these sort of organizations, and I think, as organizations themselves can actually say, what are the requirements for us to scale up? And that's something I spoke about at a webinar a few weeks ago for Unlimited as well. Because there may be many organizations that are doing a great job and want to say the scale they're doing and don't have that desire to scale up themselves, but can share and scale their impact by sharing their ideas more broadly with other people as well. So it's not about just about growing the organization. But if we look at the demand for investment, this is a quote here from a report by Big Lottery Fund involved, clearly so involved in leading on it as well, and Dan Gregory as one of the authors. But they kind of say here that talking about for a number of years there's been complaint bemoaning the lack of access to capital and suggesting if you build it, they will come. The emphasis has shifted amongst the experts to regret the absence of investment-ready propositions. In the midst of a global credit crisis and with access to finance at the top of social ventures concerns, we perversely see significant pools of unapplied capital with slow dispersal rates. And we're seeing this in a number of places as well. It's been an issue for a long in the past as well. So really there's a question here about there being a sort of gap between the supply and the demand. But there's a real need to actually understand what is the current demand and what do organizations actually want to get. So we need to here at this stage just to unpick what do we mean by access to finance. And I think in terms, this is a term, access to finance, you see it in the newspapers, particularly related to the credit crunch and the access for small businesses to get access to finance. But when we're talking about social ventures and social enterprises, this access to finance means something slightly different, and there's a bit of confusion. There's a mix, there's people sort of use the same term, access to finance, to refer to repayable or loan finance. Also, access to finance refers to sort of the need to have access to grant finance. And thirdly, some organizations we're finding also refer to sort of the need for income sources as another form of finance as well. So really when people say we have a problem with access to finance, you need to ask yourself, do you mean you want to have access to loan finance, or is it a problem with access to grant finance, or is it just an access to business opportunities that will allow them to create income to fund their other social purposes as well. And here as well, when we look at the demand, the demand for finance, so we look here at the demand for grants, looking at innovation funding, short and long-term capital as well. So I'm going to explore some of these issues, particularly looking at the types of external finance, recognizing here that social enterprises, a large proportion of them get their finance from a whole range of different sources, and this is where social enterprises can be very good at raising finance in different ways from different stakeholders that they might be doing, and from their community as well. So they are able to use both their ability to sort of have a good business with being embedded in their communities, having linked to philanthropists as well. So you can get a whole range of different forms and different ways of getting capital. And these might, and some of this might be more commercial, some might be more philanthropic. But that's the challenge here is trying to identify, what you can do, what you can get from different places. And some of our work looking at social enterprises has shown how many organizations, they change their story for these different audiences. So when they're talking to a philanthropist, they'll tell one element of what they're doing or focus on particular activities. And then when they're talking to a more commercial organization, they might tell a slightly different element of their own story. We call this impression management, that you actually give a slightly different impression to different people to actually give an idea so you can meet the different people's requirements. And social enterprises, as they are sort of organizations that combine both the social mission and the commercial objectives, are very good at sort of being between the two and being able to do that. And this allows them, and many of them, to find ways of sourcing finance. Many of it can be from local communities, or and friends and family are often used for many social enterprises, particularly when they start up. And we find that in conventional businesses as well. But what I'm going to do next is go through some of the data we've done recently from some work looking at the Social Enterprise UK's survey of social enterprises. They've looked at the different types of finance being used. So this is a survey of it's about over 800 social enterprises of different kinds, and there's some detailed questions here around what sort of finance they were using. So all the people who were interviewed were taken from a wider sample of about 6,000 organizations that were all on the memberships of different social enterprise related bodies. And we've compared this sample to other samples of other surveys, and it seems quite a robust way of looking at the social enterprise community. So looking here at the first thing we looked at was what are the types of finance sought, and we can see here what we have in the blue is the grant finance, is the sort of the social enterprise finance. In the red, I've compared it to the all small and medium enterprises. This is a large survey from the Department of Business Innovation and Skills, which have done a survey of many thousand small businesses, and again another very robust sample. The big difference you can see here is the huge importance of grant finance that dominates all other forms of finance for social enterprises. A lot of organisations might be using both grant and loan, other forms of loan finance. But I think we have to recognise that grant finance remains vitally important for social enterprises to deliver their services. But some of this grant might be grant finance for actually delivering activities, other times it might be grant finance for allowing the organisations to grow. I want to look more at the repayable finance. So I'll take out the grants and sort of bring the detail, so we can focus a bit more on the different types of repayable finance here. And this gives an idea of the different sources people are using. So the most important is loan finance, but also other forms of access to finance, things like overdrafts, mortgage, leasing and hire purchase. When we compare it to small businesses, here we can see generally that small businesses might be more likely to go for loans and overdrafts. But there are some other areas of interest where social enterprises seem to be more having more interest than conventional small businesses. What's particularly interesting are the forms of equity finance. This is when an enterprise will give a stake of its own, of the ownership of the organisation externally to other parties outside the organisation in return for sort of funding and financing the growth of that organisation. There's been a lot of talk about it on social enterprise, and interesting here it shows that well, we hear a lot about it in small businesses. You hear about venture capital and other forms of sort of ways of supporting small businesses, but actually it's for a very small proportion of small businesses get involved in equity finance. But what we're seeing here is that although it's a very small proportion, under 2% of social enterprises, it's actually a lot more than the conventional small businesses. I think this might be what's happening in a range of community shares and community bonds, where social enterprises are finding ways of having giving out shares in their organisation to community members in return for sort of financing of the organisation. So I think this is an example really where maybe social enterprises are leading ahead of other forms of private sector organisations. They're able to draw on their community links and the other benefits that they're providing. Just briefly in who they're looking at, who they're getting it from. Here we can see that banks were the most important source, almost 2/3 of the social enterprise debt seekers, and this was so it's about 2/3 of social enterprises, compared to 4 out of 5 of small businesses generally. So it's a little less than the small businesses, but still banks are the dominant form of the people looking of the organisation providing finance. And this comes to, I think it comes to about 9% of all of the social enterprises in the sample were going to banks. If we look at the social investors, the social banks, the community development finance initiatives, we find that they provide to 1/4 of their social enterprises seeking debt finance. And if we look at the whole sample, this comes to 3.6% of all social enterprises. So what we show here is that banks continue to become very important players and are providing funding for a large proportion of the social enterprises. So there's questions here about to what extent, what can be done to channel that lending from banks to maximise its social benefit. And also, what we're also finding, talking to a number of our social enterprises we're working with, is that many of them are actually giving a preference to bank finance. They're finding that many times the banks are able to understand their business proposition easily. They're able to respond quickly, quicker than the social investors, and this can be seen. The rates and the interest rates being offered again are being found very similar as the social investors having to charge interest rates that will cover their costs. So there's interesting things here about where can the social investors, where should they be focusing their resources, because as philanthropic funds they should be looking at those areas that couldn't be funded by the banks. So I'll get onto that in a minute. But very briefly, just some other things we found. We found that age matters. So here it's the particularly the 6 to 10 years. I'm sorry, this graph has missed there's a bar missing on the left-hand side of that age one, but also the size one, that those million-plus social enterprises are much more likely to go for loans. But those are the smaller organisations, just under 10% of them are going for loans as well. So we find it across the board, but particularly it's more than twice as likely for the larger ones to be going for loans. So we want to look at those who are not receiving the finance, and here we can see that it's the smaller and younger organisations. Interestingly, we found that companies limited by share have a lower success rate, and then also we found, which we kind of weren't really expecting, because we were expecting the more private sector legal forms to maybe have a higher success rate. So it's interesting, there's something happening there that we're not quite sure about. It may be that many of the organisations with other legal forms are less likely, or are some of the discouraged borrowers. So unless they've got a very strong business case, they're less likely to apply. We see sectoral differences with lower success rates. Employment and training, only 56% received all of what they're looking for, compared to about 69% for all of the social enterprises. So there were some differences there. We also saw differences in those seeking finance, and actually sort of a greater amount, particularly in social services and childcare, had over 20%, about 25% of them looking for borrowing. That compared to under sort of 15% for those on environmental services or business support and financial services. So again, there's some different patterns in different sectors as well. So we can see here that there's demand, and we've got sort of 15% of all organisations seeking some forms of debt finance. We find that this social investment is an important part of it, but it is only a small proportion of social enterprises are going to social investment. So I think when we're looking at what are the ways of supporting social enterprises more generally, social investment intermediaries and other forms are vitally important for a small proportion, and they can really fill a gap, but it has to be seen as filling a gap, and then we have to see there's a need for a wider a range of support for those other organisations that are not going to the social investment intermediaries. There is that key role for the banks, and there is this danger of social investment displacing bank finance rather than creating additional social value. If we're looking at big society capital as a form of philanthropic support that's trying to create a sort of a social investment marketplace, if it's displacing from the banks, to what is it adding that the banks are not adding? Where should it be? And the question is, where should it be focusing on? Where's that gap in supply? I think here we can look down at focusing on these gaps. We can see there's about 24% of all seekers didn't receive what they applied for, and 21% of all social enterprises did not seek, but might have if the situation was different. So these are the key segments, and this, if you're an organisation looking for finance, you can see to what extent do you fit into one of these categories. And what we've done here is developed a segmentation model. This is particularly for for the social investment intermediaries and other support organisations to see what sort of offer can they give to different types of people. So first of all, you've got of all social enterprises, you can divide them into three types. Those who are just not interested in social investment, in any sort of form of borrowing. And these organisations are probably doing a whole wide range of different activities, but they're not looking for any finance, external finance or repayable finance, and they shouldn't be, because they're probably doing a great job on what they're doing. Then you've got those who are receiving investment, and there may be those who are satisfied already. There might be people who have been successful but would like to seek more, and those people who have not received all that they've requested. So again, we can see what sort of support would you need to focus on those who haven't received all that they've requested, how you can get them be able to apply in the future and to get what they want to. But I think the key area of interest here is the third one, is those not receiving but they're interested. And I think maybe there are many organisations there who might be exploring what forms of finance should we be going for, and what should we do to get there. But this is where the intermediaries and the different support providers should be focusing their efforts. So I want to break down those types into the different types of organisations. So we've got, of those not receiving but interested, you've got those who have tried and failed. So it might be people who are organisations that have a very good business case, but they presented it poorly, and so it doesn't meet the requirements of the funders, the lenders. There's also discussion that sometimes a social mission might put off lenders. I'm not convinced by this at all, having spoken to many of the banks. They often feel that charities and social enterprises they're very happy to lend to these organisations, and they've actually found that their repayment rates can be better than lending to private businesses, and the systems in place and the assessment of risks can be very rigorous in social enterprises and certain charities compared to more private sector businesses. So in this way, it's something there. It's how you present your case to a bank or any other applicant is really important, but sometimes the social mission can actually be put there as an advantage. But then also those people who've tried and failed, it might just be what I call here a weak business case. An organisation that a social enterprise may not have that ability to generate the surplus to pay it off. And in these cases, it's quite right, I feel, that some organisations should be rejected for getting loan finance because they don't have the ability to pay it back, or the risk of them not being able to pay back might be very high. And that's something where every organisation has to go into this with their eyes open, of actually saying, can we actually afford to take out this loan? Then the second type of those not receiving but interested are those what I call the nascent borrowers. Again, some of these might be people with a weak case, and maybe these people who are interested in borrowing need to kind of really consider, do I have the strength of a business case to take a loan out? Can we get the surplus to repay that? And the organisations I'm involved in, we've often sort of debated looking for taking out loans. And sometimes it's been pursued, other times it's been rejected because we just feel we don't have a strong enough case to guarantee that we could repay the loans. And while we could scale up, there's also a risk that it could put the organisation at threat as well. And so in these organisations, a decision was made either to wait to build up the business case or maybe not to go for funding. The other form of nascent borrowers are those which could be called the discouraged borrowers, those people who have a good case but have been discouraged from borrowing. And this is where there may be many organisations, many social enterprises, which are able to generate a bit of a surplus, but again are fearful of taking out debt finance. And what we're finding in our work is that a lot of there can be a bit of tension often between the chief executive or senior management on a day-to-day basis, and then the directors or trustees of a charity who might be more risk-averse or maybe more cautious about taking debt. And I think here there's ways of sort of looking at how do you build up that confidence and the capability. How do you understand what is the best route for you to take? And I think this way, mentoring from other organisations, seeing how other organisations have taken out finance successfully and made it work are really important. But equally important, there's a need here to look at those cases where organisations have overstretched themselves. And I think one worry I have quite often is that many organisations that do take out loans and then get into financial difficulties, those lessons are not being learned necessarily. And you only hear about organisations struggling once it reaches a terrible, the worst sort of position of bankruptcy. Well, the other time you hear about it, I find, is when a chief executive leaves and a new chief exec comes into an organization. The new chief exec can then start talking about the financial position that where the previous one might have been more, felt that was more sensitive and was not willing to divulge those sort of information externally. So we've got here this idea of sort of the willingness to borrow. And so the questions here, and I think what our research shows is that there is an interest in borrowing. We've got about 15% of social enterprises currently borrowing. And so we want to know, what, on top of that, what's the emerging demand for these loans? And I think from the survey we've done, it seems to be about 21% of organisations might be in that sort of nascent borrower category. And another survey, the work by Clearly So, New Philanthropy Capital, the big lottery funded work on investment readiness, they found on their survey about 30% of voluntary community and social enterprises were seeking or interested. That sample was very much a self-selected sample based on the Clearly So and big lottery databases. So it's it's not exactly clear what organisations are included in that. But there are other questions that were asked in this survey that are quite interesting as well. So it did say that 1 in 4 of those borrowing said they did not necessarily generate surpluses to repay the finance. So there's sort of concerns there. And there's this issue about this debt burden. And you might find that, as I mentioned before, there are some sort of investment-friendly social entrepreneurs. People are very willing to go for finance and take on debt finance to allow their organisation to grow. And then you have a change of senior leadership, and then some, whether the new management is so keen on it, you can find it. And there's a question here about some people being too keen to take on debt, and organisations too keen to provide debt finance. And this is there's questions here about, is this a form of, there are risks of leading to a sort of subprime lending, which all investors and all investees are trying to avoid as well at the moment. So if we want to look at this idea of investment readiness in a bit more detail, we've got, in terms of investment readiness, as I said before, part of it is this idea of strengthening the business proposition. So again, if you're looking at the support required for this, for every organisation has to consider, what are the income streams we're getting? What are our costs of production? And then particularly here, how do we balance having a successful business proposition, generating a surplus, with maximising our social benefit? And this is a decision we have every day. It's an everyday decision in social enterprises. So like, for example, a social enterprise where I'm a director of, where we were discussing every board meeting, every meeting we have, the constant issue is, to what extent are we looking to generate a surplus, or are we looking at the business position, and how can we use that surplus for our social purpose as well? But again, that comes down to this investment readiness. How do you get that balance? And this is where organisations are constantly learning, and support is really required, helping organisations make those really difficult decisions. So looking at the example I can use is a children's nursery, where in this organisation we constantly decide on having to look to have a viable enterprise, but then any surplus we get, we'd like to put that back into social purpose. So if we are generating surpluses, we look at increasing the staff ratio, increasing the number of staff, so we can offer specialist things for particular children, looking at offering new services like forest schools and other activities, and then look at developing the nursery or the outdoor area to maximise that social benefit. But we're always looking at how do we do that, and how do we balance the business side with the social benefit. Then when looking at investment readiness, there's something about the presentation and pilot testing of those propositions. If you're going for funding, how do you present it to the funders? And again, there's interesting examples of organisations really building up their capacity and their capabilities in doing this. Quite often through getting mentors in, getting people who have done it to be their mentor, to come into their organization and guide them through the process, telling them how to pitch an idea to a funder, what to talk about, what if you've got just a couple of minutes to talk to someone, what are the key issues you need to do that. So some of this is capacity building. A lot of it is about confidence building as well. And again, investment readiness support is all about finding someone who can give you that confidence, who can provide that sort of slightly softer side and those sort of capabilities. Access to finance as well is also about networking and relationships. And again, mentors play crucial roles in introductions, making people more aware of who's out there and helping make those links as well. So again, finding a support provider who can help you with that for organizations is crucial. And finally, there's issues here around how do you demonstrate both your financial and your social returns. So if you're looking at social investors, you need to sort of show not only do you have a great business, but also you're having a great social mission as well. So here we can the needs, there's a lot of experience in the world of finance and small business about how you do the financial side, presenting business plans and the financial projections and the budgeting and the forms of accounting as well that are commonly used. But the financial side is pretty well covered, and I think any social enterprise can learn a lot from other conventional businesses as well about how to do that. And there's also some elements of social enterprise where there has some specifics there. But a key difference for social enterprise is that you're also having to look at your social return as well. So here there are interesting things about measuring your social returns, and I think there might be other talks about that. But it's all about how do you measure that social, what sort of metrics, what sort of measurement do you use to demonstrate your social impact. And here you can, there's challenges here of how you measure, what you measure, and there's also difficulties here about comparing projects against projects, enterprises against enterprises. And the actual use of what we're finding here, and we've done some other work looking at how organizations are measuring their impact, and this is looking at some of these issues about how you used your impact measurement to show your legitimacy, to show that you are doing a good job and you've got that social impact as well. But what we are finding is this, with increasing competition, some organizations don't want to publicize their social impact, or they're actually sometimes playing it down because they don't want to be accused of exaggerating it. But we are finding that there is more, there's a risk of people using very different ways of measuring their impact, and then other organizations comparing themselves to their competitors in terms of social impact, but in ways that have been measured very differently. So we're comparing apples and oranges, really, when they're measuring quite different things. So there's real risks here about measuring a social return. That's one of the key challenges of measuring. So I think this, in this way, there's a need to sort of pick different types of measurement that you really feel happy about, that actually tells the right story. And sometimes you might want to do something that puts a financial or a monetized value, such as social return on investment, and other times you might want to pick other types of measuring impact. And I think there's different ways of deciding what's the best way of measuring the impact. But again, you've got to think, what am I doing it for? Is it for my own learning, or is it for other people? So I think here we can look at ways of knowing your impact, why you're doing it, and in our research found the large extent that people are doing it for external pressure from different investors and funders and commissioners. They're sort of reacting to them saying, we have to do it. We also find many are doing it for learning, and a lot of the tools for measuring impact are for learning. But then we're finding an increasing number of organizations are doing it sort of proactively to sort of attract investment, to win contracts, to actually to grow the organization as well. So I think in this way we're seeing all sorts of different motivations for measuring the impact as well. So when we're looking for, in terms of social investors, to what extent are they actually looking at the social impact? We're finding that it's limited at the moment, that the social investors are not actually comparing organisation against organisation based on its social impact. But what they are doing is actually wanting organisations to be in the process of measuring their impact, because the actual process of measuring your impact is an indication that you're taking your social outcomes seriously and that you're really looking to learn for the organisation themselves. And this really does lead to a number of challenges for the social investors, because you've got so many organisations, so many different ways of measuring. So we've got the challenges for social investors in both in deciding what outcome indicators are they looking for, what methods do they want to do. There's also a huge cost in measurement, so should the social investors be covering that cost? And then there's a risk of the social investors saying, you must measure in this way, or I want you to measure these indicators. This might have a negative effect on innovation within the organizations. So let's say in the past, a lot of organizations have been judged on their job creation. That can be done in quite a crude, that might be limiting. It's not, it depends on, there might be organizations which are innovating to develop services that work on particular types of beneficiaries who might have particular needs. So actually a crude way of measuring jobs created could be an indicator that doesn't actually encourage the innovation that they want to do. So there's issues here about organizations using their own discretion and also interpreting the results in different ways. And then there's an issue of dangers of comparing the uncomparable. And we do find this particularly in some things like social return on investment, where you get a ratio for every £1 invested, what is the social return? And in the past, people were reporting 1 to 2 or 1 to 3 as a good example. But now we're finding that people who are doing very rigorous measurements of that and maybe finding that they are making a good return, like a every £1, a £3 return, they're feeling embarrassed about reporting that because other people have measured things in a slightly different way and made different assumptions and have got a higher ratio as well. So there's an issue there about comparing what you shouldn't be comparing. And also there's an issue when people aren't reporting what their impacts are, is that we're not able to do what we call smart failure. When people aren't, I've never really seen any evidence of organisations where they've actually reported a negative social return. So they haven't got their money back from it. And I'm sure there are cases where it's happened, but people aren't willing or able to report because it's a competitive environment. So looking at time, I'll just skip through to the conclusions. Going back to the social investment then, it is providing finance for delivering the social benefit. So it needs to do both that. It needs to have a good financial case and it needs to have a good social benefit case as well. But as I said, the loan finance and debt finance is only a small part of the sector. So it's not a substitute for other forms of support and capacity building. So we really need to know what is the type of the gap, what is the niche, is there unmet demand? I think one of the key area here of unmet demand is those discouraged borrowers. And that might be, the organizations that maybe lack investment readiness. It might be about the quality of their business proposition. And also there's a danger for lending for those with a poor business case as well. And really there's questions here about the social investors as well. Where can they really have a maximum social benefit here? Where it's a very exciting time of having such large amounts of resources put into social investment, and it can have a huge benefit by lending to those organizations that can't get finance from any other source, that can't get finance from the banks as well. So it's really about how can we channel all that energy, all those financial resources to maximize the social benefit in the future. So I'll finish there. Thank you very much.
Thank you, Fergus. Thank you very much for that webinar. If anybody's got any questions, if you'd like to type them into the chat box or the questions box now, we can spend the next 5 or 10 minutes doing a bit of a Q&A. So I'll just give you a couple of minutes to do that. Just to let you know, like I said at the beginning, we have recorded the webinar, so we can send out the link and the slides as well, so you can listen again and look through the slides at your leisure. We've got a couple of other webinars coming up. Well, we've got a whole series of webinars coming up, but I'll just draw your attention to the next two. So we have one this Friday, which is all about the Unipop shop and how you can get involved. The Unipop shop's actually taking place on Tuesday the 24th of June at Spitalfields Market in London, and it's organised by Bath University. But if you're interested in that or attending the actual pop shop, then please listen to our webinar on Friday. Following that, our next webinar is on Monday the 16th of June, and it's all about the roles of directors and trustees and what you need to know, particularly around all the legal implications of having directors and trustees supporting your venture. So again, that will be a very informative webinar. So let me just see if we've got any questions here. Oh yes, we've got one here. So I'll just read this out. Fergus, if that's okay. Were the cases recorded known when social enterprise took out a commercial loan and was not able to pay back? What were the consequences of that? So the cases that are recorded, the ones that you know about, where the social enterprise took out a commercial loan and was not able to pay it back, what were the consequences of that?
I think there's, often it's an area where it's often very hidden, and I think that's a big worry, that we're not really learning from these examples. And I think it's hidden because people are ashamed of it. Well, actually, which is quite interesting compared to private entrepreneurs and the sort of mainstream businesses. A lot of entrepreneurs actually sort of almost celebrate their mistakes, and many great entrepreneurs have often started and gone bankrupt or failed in the past and have learned from it. So with the way that people are hiding these sort of problems is a way that we're not learning from it, and maybe I'm not sure the extent they're learning, the individual social entrepreneurs are learning. But what we do find that I can think of sort of three sort of different sort of approaches. First of all, we found that organisations, they might have an enterprise, they've taken out a loan to develop that enterprise. They aren't able to make a go of it for many different reasons, sometimes outside their control. And where they do have to pay it back, they end up, rather than going into bankruptcy, they'll sell off assets, they'll scale back a lot of their activities, and then they will use that to pay back the loan so that they can continue, the organisation can continue. The second approach we find is that there's organisations that might be getting into financial difficulty this way, and this can lead to a merger. And we often find that organisations that are financially in financial difficulty, they don't close as often as they don't close as a but rather they sort of go into more of a merger, or they get taken over by another organisation. And we're seeing a lot of that now as the funding systems change. A lot of organisations lost their funding that they might have had, particularly due to our period of sort of austerity, and public sector funding drops, and then organisations merging or being taken over by other ones, so that some of the staff can be kept on and the services can still be continued, but under the umbrella of another organisation. And then the third way really is organisations closing completely. Whether they close because of the finance or because of other reasons, it's often left very unclear. But that's where I would look for future examples, and would trying to find a way of people being able to report things that haven't worked. So we're looking at ways of reporting failure, and we're working with New Philanthropy Capital actually who are particularly interested in how can we have anonymous reporting of things that haven't worked, where organisations have failed. What were the lessons learned from that? How can we get that out to everybody? So that's something we're just still starting to work on, but that's the worst scenario, where the users of the service are really going to suffer. But I mean, we have to expect that there will be cases. We've got very ambitious entrepreneurs who are looking to grow, and maybe finance is the best way of growing, and it won't always work out. And we don't want to be, maybe that it's getting that right balance of risk, so that we can maximise the social benefit in different ways. But maybe there will be times when organisations will suffer. It won't be able to repay back their loans whether it is because markets change, competition changes, all these sort of factors come into it. But I think any organisation looking for loan finance has to go in with its eyes open, knowing that there are these risks, and how could they cope with those risks.
Great, thank you, Fergus. I'll just wait a couple of minutes to see if there are any more questions that come through. But that was a really informative webinar today, so I hope everybody who's listened has enjoyed it and learned a couple of new things from it. If people don't want to ask questions right now but think of anything later and want to drop me an email, that's absolutely fine. Julie Nicholson at unlimitedunltd.org.uk, and I can always forward that to Fergus. But it doesn't seem there's any more questions at the moment, so I think at this stage we'll look to end the webinar. So huge thank you, Fergus. That was really informative and hopefully very helpful for the people that listened in. Like I said, hope you can join us on the next 2 webinars, and Fergus is running another webinar later on in June. Oh, very last minute, another question has come through, so we'll just look at that one. So the question is, grant loan mixed funds seems a definitely more sensible approach for startups and early stage businesses. But do you know of any evidence for this, Fergus, at all? So there's grant loan mixed funds.
So mixed funds, is it sort of, I don't know if this means mixed with loans or mixed with other forms of approach, but I definitely agree that grants are very important at the early stages. And we're finding this in small businesses generally anyway, that most small businesses don't take out loans in the very early stages because they're not, they don't have the track record and they don't have the business proposition in place, and so they have to find other forms of finance. The classic one is friends and family, and people sort of starting with those forms. For social enterprises, it's the ability to start with grants, and a lot of businesses as well start with grants, public sector grants as well. So we mustn't, this idea of grants being bad, we definitely want to get away from that. Grants should be focused on particular areas to allow organisations to grow, to get up to a scale where they can look for other forms of finance. So it's all about how, what I want to push is to how do you get more grants for those startups and for those areas where they wouldn't be able to get other forms of finance. But I don't want to, I think sometimes, maybe in the past, there's been grants given where the organisation could have found other forms of finance. So it's all about maximising that the social benefit that can come from any form of funding. But particularly for startups, there's a real need to have those sort of forms of grants to get them going.
Great, thanks, Fergus. Okay, well, if there are any more questions, if people would like to drop me an email, and I can forward that to Fergus. But thank you, Fergus. Thank you very much for today, and thanks everybody for listening. It's now 1 o'clock, so we'll draw this to a close, and I hope everybody has a good rest of the day. So thank you very much, and goodbye.